Okay, welcome to Learning Module W6, Week 6, D. In this module, we're going to talk about supply management risk. And it's as complicated as the world is. There's a lot of different risks that come to bear in managing a supply network. We'll talk about some of those, and then I want to give an example of a price disruption risk and give you a feel for what that might feel like if you were sitting in that chair. So here's a very useful graph I found, a nice chart that I found I thought gives a pretty good picture for understanding where some of these risks come from. So it's grouped into environmental, geopolitical, economic, and technological. And it also has, which I very much liked, some likelihood, some probabilities in there, right? So here on this side of the graph, depending on the darkness, is the probability of some of those risks, which is generic, right, across industries and around the world. So, but we could still make some sense out of that and say, how probable is this? And then how controllable is the darkness of the other side of the circle? And how many levers do we have and opportunities to take action, right, to avoid or mitigate that risk? So if we look across here and we think about natural disasters, we hear about them, right? Things like the hurricanes and earthquakes generating tsunamis and so forth. And we realize when these natural disasters hit just how global business has become, because we'll start seeing headlines about, this industry is highly dependent on that part of the world, and this industry is going to shut down for a little while they wait for that particular part of the world to recover from whatever it might have been, right? A natural disaster or otherwise, political instability and so forth. So we can think about environmental disasters, and we can try to locate plants and locate suppliers in ways that mitigate some of that risk. And we can build our supply chain further, proactively thinking about risk of environmental disasters. And we can do the same with geopolitical. So politics is not completely predictable, but we do have more or higher and less volatile forms of government around the world, and governments that have strong institutions that can weather some instability. And we have other governments that can't weather any instability by leadership at the top. An example of that that we've seen recently in the United States has been the talking about rewriting NAFTA and tearing up NAFTA and so forth. And overall, that hasn't had a big impact yet on our economy and on investments. People are wary, they're concerned, but they also have confidence in our institutions that one person, right, isn't able to just rewrite the way we do business around the world. So there's a counterbalance because of the stability of our institutions. Trade restrictions, terrorism, corruption, right? That's something that can be inside at a transactional level, or it can be part of a geopolitical economy. That if you want to do business in this part of the world, you've got to understand that there is corruption involved and decide how you're going to deal with that. Our rules for corruption in the United States don't always match the rules, the expectations, and the norms around the world. So we have to figure out how to deal with that if we want to work for and be part of a global corporation. Then there's a very difficult job of navigating through how do we do business in that country if we want to use the U.S. rules for ethics and corruption. Sometimes we can't. Sometimes we have to stay out of a market. Piracy, So you hear about a lot of these things in the news, and ships do get attacked and raided and so forth. Economic risks, demand shocks can be quite disruptive for an industry. Price volatility, when the price is unstable and we can't build a predictable business around it, it makes our contracts and our way of a stable way of doing business very challenging, right? Border delays. Sometimes we just don't have the capacity at borders to move goods. And as global trade expands, we need more and more ports, more and more ships, more and more rail and trucks and transportation, right? And it doesn't always appear before we need it. Sometimes it's after, many times it's after we need it, and there'll be delays of all sorts. Currency fluctuations. So we have long-term trends and some predictability in currency, but it can move if you've got a tight margin. Currency doesn't need to move very far for you to move from a profit to a loss. And so, depending on how we write our contracts, currency fluctuation can be a huge risk for one party or the other, the buyer or the seller, right? Energy shortages, and last, technological disruptions. So telecommunication disruptions. So, having hackers maybe bring down a part of an infrastructure, or having a disaster take down part of an infrastructure. So we can have all sorts of different telecom disruptions. Denial of service attacks would probably be one that most people have heard of or could relate to. So this shows you a broad range of issues that firms have to watch out for. And you could even go deeper into a few of those and say, and then even inside our supply chain, we've got issues like a single supplier going bankrupt and becoming insolvent, right? Or a single supplier not having the capacity or the skills or the quality levels to do what we need done. I want to look at an example of price volatility that I found interesting. I lived through this one, and I was thinking about it when I thought about supplier risk management. So let's take a look at something that happened here in steel, right, in the United States and globally. The price of steel was rising fast, and it had doubled in 6 months at one point in time. Steel mills were breaking contracts and basically saying, I can earn a lot more on my steel capacity than what I contracted to you for. So if you want the steel, I'm not willing to sell it to you at the price we legally contracted it for, right? And they were letting people spend money suing them in court because the profits were so big by breaking the contract. So they thought they would win more than lose. And so there are big battles going on, fighting over contract enforcement, reselling their capacity at high prices. And then B2B customers were pushing back in the industry I was in, automotive. The big customers, the Toyotas and the Fords and the General Motors and so forth, were saying, we're not going to absorb this huge increase in steel unless you got a contract that says we have to, right? A contract that's built around us absorbing cost fluctuation. And a great many suppliers did not have those type of contracts, many suppliers. So they were stuck in a situation of risk here, right, of a volatile raw material price and sometimes a customer contract that did not allow for recovery of that. And even if you had a long-term contract to buy on the supply side, sometimes your supplier saying, hey, sorry, I can make a lot more money with this steel somewhere else. So you either pay me a higher price than our contract, or you're not going to get this steel. And huge legal battles going on around that. So we could say that a tier 1 stamping supplier at that point was at risk of survival. They could go bankrupt if they didn't find a strategy to deal with it. This is actual data from CRU that shows how steep that price was going up. So if you look at it over 4 years, you see on an index point of view, us going from about 115 to 222 or 223, almost doubled in 4 years, but even more alarmingly, what had been going on here in the last year or so. Up, a little dip, and then the steepest rise, right, that anybody ever seen. So sheet steel was selling for prices it had never seen before, double what it had ever seen before. And you can see here some of the forecasts were that prices are going to continue upward from where we are, right? So everybody's dying at this price. If they didn't have recovery from their customer, they were just dying at that price. And strong demand overseas, so we're not going to see imports rush in to fulfill, to bring supply and demand back into balance. And that had normally been the correction for the steel markets, that whenever prices in the U.S. would get out of whack, imports would come in and bring the market back to equilibrium. So strong demand overseas, keeping foreign sources from plowing into their steel into our market. They were getting good prices overseas. A weak dollar, which made it difficult for imports again to come in and flood in and take advantage of this strong market in the U.S. and bring our prices back down, frankly. The dollar was weak, which means it's not attractive to sell in. It's attractive to sell out of the U.S. when the dollar's weak. And high-cost ocean freight. So the overall globalization kept driving up the cost of transportation as well. So we weren't going to see a recovery here from foreign sources. The normal correction that had always happened in steel wasn't happening. Just enough demand in the U.S. to keep inventories low and prices high. Mills tearing up contracts, service centers breaking contracts, and kind of a bleak outlook of what to do. So what are your options to obtain steel, purchase steel, and avoid economic loss here? Well, we could try to enforce contracts, right? We could spend a lot of money with lawyers trying to force the steel buyers to ship to us at the prices that we contracted. And a lot of that was going on in the industry. They have ways to, of course, drag things out. It's hard to get an injunction and an order sometimes from the courts where you think you're entitled to one. The courts don't tend to like to get into squabbles between two businesses, so they don't always act, in a way that is in your best interest, right? They don't pick sides, and they don't always want to be involved in those commercial disputes if they can stay out of them. We could go to the spot market. The spot market means just go to market and buy at market price. This is going to be very expensive, right? So that's not a better alternative than just giving in to the mills and saying, okay, I'll pay you more. The spot market's not better than that. It might be worse. We could renegotiate with the mills and service centers and just raise our price to say, okay, it's wrong, but I need steel and I need it now. And there's no ifs, ands, or buts about that. I need steel and it must be delivered. So I'm basically being held hostage in that case. And renegotiating or reluctantly agreeing to pay higher prices, or I don't get the steel, right? It really is coercive. I could demand that my customers pay for the increase, which seems rational. If the whole market has gone up and I have a legitimate cost the same as everyone else, right? Shouldn't that ultimately be passed on to the consumer? It is logical, but it doesn't work that way when you're playing the game between two companies, right? They'll all behave differently. They'll behave however they behave. And in many cases, customers would say to the firm I was dealing with at the time, no, we're not going to pay it. We have a contract. It is a zero price increase contract. In fact, you owe us a cost reduction maybe in 6 months when January 1st hits. So, no, we're not going to pay it, and make sure you ship us so that, we don't have to take your business away from you for violating this contract, because there's awful damages when you just don't shut down car makers. There's horrible, horrible damages, not just to goodwill in the relationship, but economic damages for shutting down an automobile assembly plant are really expensive. So the other option could be we could use our stamping presses as decorations out in front of the building and put up a gone fishing sign, right? Because if we don't have steel, we don't have a business. It's that simple. We'll be replaced. Our customers will be in here so fast, pulling their tools out of here and shifting them to another supplier. If we don't deliver parts, we won't have time to blink, and they will have court orders for those. So we have to keep building, and we're not getting steel. In this case, the company that I was working with at the time found they really had no choice but to negotiate with the steel mills and to pay a higher price, and then to go back and hope to successfully sue for damages later. There were a lot of weasel words going on and side letters with assurances to never sue and all this. If you get this material, you got to release us from any damages for blah 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 from that last contract. So it was a bad ethical time. But we renegotiated some contracts and we got the steel that we needed. And I just need to let you know finally the addendum to the story to let you get a good chuckle. The timing of that was in the fall and summer of 2008. I deliberately took the years out of it earlier so you wouldn't guess the answer and the horrible result of this ahead of time. But the steel market collapsed in the second half of 2008. So right as companies were agreeing reluctantly, coercively, to sign new contracts and to access this steel at prices that they shouldn't have been asked to pay in the first place because they were under contract. So you lock in a year at this new high price, and what happens? The bottom fell out of the global economy. It was the global meltdown of the fall of 2008. Complete economic collapse. So here's our peak, $12.65 a metric ton for cold rolled steel. That's 2,200 pounds of steel, the metric ton. And here's the collapse, right? So by December, the steel's back and even below, right, where we were when all this fiasco started. And it stayed low for years, and in fact even hit a bottom here just recently here in middle of 2016. It hit a low of recorded history, right, of long time. And it's now stable at about $312. So you can see the interesting saga here of being a steel buyer in a commodity and some unethical things that were going on at the time industry-wide because of greed, and that you could have got hurt on both sides of that if you didn't have power in the negotiation. You could have got hurt going up, even though you had contracts, and boy, you could get hurt on the other side. So imagine now that you've locked in for a year at $12.65 or something like that, right? That your customer's not willing to pay you for. So you just signed up for an absolute beating so that you could stay in business, probably giving away free parts almost by the time you finish paying for all this steel. And free, I mean, just recovering your costs, break-even parts. And then the bottom falls out, and you could have been rolling in the money if you just could have rode it out. So these kind of things happen in, that's an extreme example, but I wanted to give you a chance to see something a little bit interesting from a risk management perspective, and how there's opportunities for try to mitigate those risks in one way or another. And even those can backfire, right? And a whole new risk kicked in when the economic collapse hit. So there you go. I hope you enjoyed that little walk through steel and our discussion about risk management. In summary, supply management is increasingly strategic, right? It has a significant impact on the performance of the firms, and risks can come in many forms. The biggest thing to know about risk is look at it multidimensionally, multi-layers, and to be proactive. The biggest cost of risk is often just being reactive in the way we manage it instead of proactive. So whatever the risks are that you decide are relevant to your business, it's usually very good policy to be monitoring those things, thinking way ahead of when it actually hits. What do we do if, right? What do we do if a tsunami blocks our, stops our shipments from somewhere halfway around the world for a month? What do we do? All right, can we move the tools and start production somewhere else a week onshore? What would it cost us to do that, etc.? There we go. That's it for that part of our discussion. I hope you enjoyed it. Risk management,